If you go on YouTube, and specifically if you look at investing YouTube today, you're going to see a lot of very similar thumbnails and video titles. You're going to see a lot of bright red thumbnails, a lot of looks of panic on people's faces, and talking about how the stock market crash is coming. And I wanted to go a different route because I think having all this negativity about the stock market is really detrimental to people that are just getting started and people that maybe aren't used to this type of chop. So I'm going to go a different route. Panic doesn't get you anywhere, but I think it's really important to have an understanding of why it's not worth panicking and selling out of the stock market because we have one big red day. In today's video, we're going to be talking about positive things about the stock market going down. It isn't something fun to talk about. People want to make money and they hear, the stock market on average returns 10% a year. It'd be great if that was, in increments of whatever 365 divided by 10% is. But that's not how it works. You're going to have the stock market go up 1% and then down 0.75%. And days like today, you're going to have big red days. I'm not going to talk about why the stock market went down. You can do some research if you're pretty curious. Also, be sure to stick around to the end of the video because I got something special for people that make it to the end. I'm going to talk about some of the important things to remember when we have red days like this and bring some positivity. Before we get started, I'd really appreciate if you hit that like and subscribe button. 91% of you guys aren't subscribed, and I'm trying to boost my numbers and try to get the motivation back into making videos. Also, if you guys want to throw a comment in the comment section, even if you put something just like for the algorithm, I really appreciate it. So let's start talking about positivity, because if you start investing in the stock market and you see a day like this to start 2022, it can be pretty upsetting, but I think there's some important things to talk about. 2021 was a really good year for the stock market when you look at the entirety of the year, but just a couple months ago, we were talking about the worst day on the stock market, and I even made a video talking about why. Is it time to panic? No, it was not. So the worst day for the stock market in 2021 was on November 25th. If you just look at that one day and read the headlines about why the stock market was down so much, you can get really spooked because the media, the way you get clicks and the way you get clicks on YouTube is talk about panic and what a stock market is going to crash. I'm trying to go a different route from now on. But if you zoom out and look at how the entire stock market did for 2021, it returned 2.5 times what it has returned on average. It went up 26%, whereas the average for the S&P 500 is around 10%. So it had a fantastic year. If you just zoom in on these little blips where the stock market goes down, you hear a lot of chatter about why the stock market was down so much, you're going to think the stock market had a really tough year. It didn't. Just people don't talk about when the stock market goes up 0.5% because it's not news. But when the stock market goes down 1.5%, it's big news. So I think it's really important to remember that panic gets clicks. And on a day like today, you're going to see a lot of people talking about negativity, when in reality, you have a lot of really good days in between these really tough days. So what happens if the stock market continues to fall? Because that is a real possibility. We had some news today that could push the stock market down for the next couple weeks. I don't think that's a reason to panic either. The stock market falling is very normal, and bear markets are when the stock market falls 20% from its previous highs. And it's happened 14 times in the history of the stock market, and there's been 15 bull markets that go along with that. But with bear markets, we recently had one back in 2020 that broke the streak of the longest bull market in the history of the stock market. In that bear market, it was also the shortest bear market, but that happens on average every 5.4 years since World War II. We just had one. In all reality, it's possible that it happened, but based off the numbers, it's very possible that we don't see one for another couple years. It takes more than just the Federal Reserve coming out with some news to push the market into a bear market territory. So that's something important to remember. But if it does continue to go down, let's talk about some things, because on average, stocks go down 36% in a bear market. That sounds really bad. 36% on your investment? That's tough. But if you look at the bull markets that on average last much longer than the bear markets, on average, a bull market has returned 114% for the 15 bull markets that we've seen in the history of the stock market. So while we see these bear markets, they are going to happen. They're a natural part of the stock market. The bull markets last on average longer, and they have higher returns, and that's why it's beneficial to keep your money in the stock market. Because if the stock market on average lost you money, it wouldn't be sound financial advice to put money into a retirement account. It'd be much better to buy something more physical, like a gold. But I want to talk about a crazy graphic that I've seen, because you're going to see stuff. I saw financial education. I saw Jeremy saying that he was selling everything, which I'm sure if you actually watch the video is not true. But I think timing the market is something that even I've made mistakes about this in the past year. Trying to time the market sounds great. You want to buy at the bottom, sell at the top. It just sounds so easy. Why doesn't everyone do that? Well, the hard part is picking the bottom or picking the right time to enter. And if you're going to be investing for your future and not just investing to make a quick buck, the timing for when you enter trades really doesn't matter. It just matters about staying in the stock market. So I want to talk about this graphic that shows the returns from the decades from 1930 up until 2020. And you see some varying returns. You see minus 42% in the 1930s, really tough. And then in the 2010s, the stock market was up 190%. But I want to push your view over to some of the stuff that isn't as fun to talk about. It's more fun to talk about trying to pick the bottom. But I think the more important thing to talk about is missing the really great days. So this graphic shows your market returns if you exclude the 10 best days per decade. And so since 1930, if you had just kept your money in the stock market, you would have made 17,715%. If you missed all of the 10 best days from each decade, you'd only make 28%. What this means is you're going to have these really panic-inducing big red days that are going to get the media talking about it. People are going to talk about, oh, is the economy broken? But the really important thing is not to be avoiding those, because you do see that 3.8 million % returns if you can exclude the 10 worst days. But it's really important to keep your money in for those 10 best days. That's where you're really going to make your money, and it's even harder to pick those days. You can see catalysts for why the stock market's going to go down. Federal Reserve coming out with minutes, that was expected. Missing the 10 best days of the decade is what really misses the long-term returns that you're looking for. So on days like today, people are going to be talking about panic, if they're going to be selling, what they're going to be doing to take advantage of this next crash. I think the important things to remember are people are going to talk about the red days more than the green days, and on average, there are more green days than red days. If the stock market does continue to fall, bear markets are shorter on average than bull markets, and it falls less than the bull markets do go up. That's why it's beneficial to invest in the stock market. And there was one in 2020, so it happens every 5.4 years on average since World War II, so it's possible that we may wait a little longer until we see one. And then it's just the importance of keeping your money in the stock market. I think the biggest mistake that I've made in the past is trying to sell and time the market, where if you miss the best 10 days of a decade, you're not going to make very much money. And that's the thing that we're looking for. We're trying to be stable, don't make any rash decisions, and just kind of keep chugging, keep putting money in, and that's how we're going to build wealth going forward. So if you made it to the end of the video, I really appreciate you being here. Be sure to leave a comment down below about a stock you'd like me to talk about. And at the end of the month, I'll make a special video talking about all the stocks that were commented on my videos in the month of January. Thanks for watching this video. I appreciate all the support, and I will see you in the next video.